In the year 1985, an American economist named Hyman Minsky proposed something that sounded almost absurd at the time. He said that stability itself is dangerous, that the calmer and richer an economy feels, the closer it is to breaking. And Wall Street mostly ignored him. Then, 2008 happened, and suddenly everyone was quoting the Minsky Moment. But here's what almost nobody talks about. 800 years before Minsky, a jurist living in Persia had already mapped out the psychological mechanics behind that exact collapse. He didn't have spreadsheets. He didn't have interest rate models. What he had was something rarer, a theory of why human beings ruin their own prosperity. His name was Hamid al-Ghazali, and this is not a biography. This is a diagnosis of him, and through him, of us. Let's start somewhere unexpected. Not in a mosque, not in a classroom, but in a marketplace in 11th century Baghdad on an ordinary Tuesday. Picture the scene. Grain merchants haggling over prices. Silk traders fresh off caravans from Central Asia. Money changers weighing dinars on small brass scales, checking for shaved edges and diluted metal. This was not a primitive economy. It was arguably the most sophisticated commercial network on earth at that moment. Baghdad had checks, promissory notes, credit lines between cities, and merchant partnerships that functioned like early corporations. In some ways, an 11th century trader moving goods from Basra to Bukhara was operating a more complex financial instrument than a small business owner in 19th century London. And yet, in the middle of all that sophistication, something was quietly rotting. Coins were being clipped, weights were being rigged, fortunes were being hoarded in private vaults, while day laborers went hungry 2 streets away. This is the world Ghazali was born into in 1058, and it shaped a question that would define his life's work. Not, how do we get richer? Everyone was already asking that. His question was stranger and more dangerous. What does wealth do to the people who hold it? That question sounds almost like psychology, not economics, and that's exactly the point. Most people assume economics started as a science of numbers. It didn't. It started as a branch of ethics, and Ghazali was one of its sharpest early practitioners, centuries before anyone used the word economics at all. Now, to understand why his ideas hit differently than, say, Aristotle's, you have to understand the career he walked away from. By his early 30s, Ghazali held a position roughly equivalent to a chaired professorship at the most prestigious university in the Islamic world, the Nizamiya in Baghdad. He had status. He had a salary most scholars could only dream of. He had the ear of powerful officials. And then, according to his own writings, he had something like a breakdown. Not from failure, from success. He looked at his own comfortable life and became convinced that comfort itself had made him spiritually and intellectually lazy. So he did something almost no tenured professor today would do. He quit, gave away his possessions, and spent years wandering as an ascetic. When he came back, he wasn't the same thinker. He was sharper, harder to please, and far more suspicious of wealth that didn't serve a purpose. That personal collapse and return is the hinge of everything he wrote afterward about money. He wasn't theorizing from a library chair. He had lived on almost nothing, then gone back into a world drowning in luxury, and he could see both sides with unusual clarity. So let's get into the actual ideas, but let's use modern comparisons he never could have imagined, because that's where this really comes alive. Take his idea about hoarded wealth. He called money that sits idle a kind of theft against the community, because circulation is what gives money its social function. Now compare that to something concrete, the multi-trillion-dollar phenomenon of corporate cash hoarding in the early 2020s, where some of the world's largest companies sat on enormous reserves instead of investing, hiring, or expanding. Economists have entire papers debating why firms do this. Risk aversion, tax strategy, market uncertainty. Ghazali would have skipped the spreadsheets and gone straight for the diagnosis. Money that stops moving, stops serving people, no matter how justified the hoarding feels to the person doing it. Or take his warning about manipulated currency. He wasn't talking about central banks. Those didn't exist yet. But about rulers shaving precious metal out of coins to stretch a shrinking treasury. Functionally, that's identical to modern currency debasement through unchecked money printing. Same mechanism, different tools. And here's a detail rarely mentioned. Ghazali specifically predicted the psychological aftermath of debasement, that people would start refusing the weakened coin and seeking out currencies they still trusted. You can watch that exact pattern today in economies experiencing runaway inflation, where citizens quietly shift savings into US dollars, gold, or other stores of value the moment they stop trusting their own currency. He wasn't predicting central banking. He was predicting human behavior under broken trust, which turns out to be remarkably consistent across 1,000 years. Now, here's where I want to push further than most explanations of Ghazali go, because there's a piece of his thinking that gets flattened when people summarize him quickly. He didn't just say greed is bad. Well, that's a lazy reading. His actual argument was structural. Greed becomes dangerous, specifically when it's rewarded faster than honesty is. In other words, it's not really about individual morality, it's about incentive design. If a market punishes the honest merchant and rewards the one who cheats on weights, you don't get a society of a few bad apples. You get a society where cheating becomes the rational strategy, and eventually the default one. This is strikingly close to a concept modern game theorists call a race to the bottom, where competitive pressure forces everyone toward the same corner-cutting behavior, even people who'd rather not do it. Ghazali essentially beat modern behavioral economics to this insight by describing markets as environments that shape character, not just environments that reflect it. Let's sit with an example he never could have used, because the technology didn't exist: algorithmic trading. High-frequency trading firms exploit tiny price discrepancies measured in microseconds, sometimes contributing little to the real economy while extracting enormous profit from the plumbing of the market itself. Defenders call it liquidity provision. Critics call it a tax on ordinary investors who move a fraction of a second slower. Ghazali's framework doesn't need to understand microseconds to judge this. His test was always the same. Does this activity produce something of real value, or does it simply extract value from someone else's effort? That single question, production versus extraction, might be the most quietly radical idea buried in his writing, because it cuts through centuries of debate about which economic activities actually deserve praise. Now, let's talk about something the earlier popular tellings of his ideas tend to gloss over: his view of rulers, and why he was harsher on the state than on ordinary merchants. Ghazali lived through the fragmentation of the Seljuk political order, a period of constant power struggles between sultans, viziers, and regional governors. He watched rulers do something depressingly familiar. When their political legitimacy weakened, they didn't fix the underlying problem, they squeezed the economy instead. Higher taxes, debased coinage, seized merchant property to cover military expenses. His conclusion was almost brutal in its simplicity. Corruption at the top doesn't stay at the top. It cascades. When a ruler cheats the public, the merchant feels licensed to cheat the customer. When the customer gets cheated, they stop extending trust to their neighbor. Trust doesn't erode from the bottom up. In his model, it erodes from the top down, like water finding cracks in a foundation. Compare that to research on institutional trust done centuries later. The finding, repeated across dozens of modern economies, that countries with corrupt and opaque governance almost always show weaker currencies, higher black market activity, and lower long-term investment. It's not a coincidence Ghazali landed on the same pattern using nothing but observation and a very sharp memory for how empires around him kept collapsing. But here's the part of his philosophy that I think gets the least attention, and honestly, might be the most useful piece for anyone watching this in 2026. Ghazali didn't think the solution to corrupted markets was eliminating markets. This is crucial, because it's easy to hear moral critique of wealth and assume you're listening to an argument for poverty or anti-commerce asceticism. That is not what he argued at all. He explicitly defended trade as necessary and even noble, and he respected merchants who built genuine value. His target was never wealth itself. It was wealth stripped of responsibility, of profit, with no tether to contribution. Think of it less like a sermon against money and more like an engineer's warning about a structural flaw. The beam isn't the problem. The missing support underneath it is. This distinction matters because it's exactly where a lot of modern political arguments about capitalism go wrong on both sides. One side treats all profit as inherently exploitative. The other treats all regulation as inherently oppressive. Ghazali's framework slices right through that binary. The question was never profit, yes or no. It was always, does this profit come from creating something or from someone else's loss? That's a test you can actually apply. It's not ideology, it's almost forensic. Now let's zoom out, because there's a bigger historical pattern hiding underneath all of this that rarely gets mentioned in discussions of Ghazali. He was writing during what some historians consider the twilight of the Islamic Golden Age's economic peak, a civilization at the height of its wealth, right before centuries of fragmentation, invasion, and instability reshaped the region. Historians still argue over the exact causes. The Mongol invasions decades later, shifting trade routes, political fracturing among competing dynasties, environmental strain on agriculture. Nobody claims Ghazali predicted the Mongols. That would be absurd. But it's worth noticing that he was diagnosing internal decay, hoarding, distrust, corrupted incentives, at almost exactly the moment historians now identify as the beginning of long-term systemic fragility. Whether or not there's a direct causal line, the timing is uncomfortable in an interesting way. A society can look unstoppable from the outside, while quietly losing the internal trust that held it together, and by the time an external shock arrives, the foundation is already cracked. That pattern shows up again and again across history, and it's worth naming a few completely different examples than the ones usually cited. Venice, at the height of its maritime trading empire, slowly shifted from a merchant republic built on genuine commerce into an economy increasingly dominated by rentier wealth and closed aristocratic guilds. Its relative economic decline followed not from a single crisis, but from decades of ossified, extraction-based privilege replacing productive trade. Song Dynasty China, centuries earlier, developed one of the most advanced monetary systems in the pre-modern world, including early paper currency. It also suffered devastating inflation crises when the state overissued that currency to cover military spending, eroding public trust in money that had once been remarkably sophisticated. Different centuries, different continents, different religions, same underlying failure mode, currency manipulated for short-term political survival, wealth increasingly hoarded or extracted rather than productively circulated, and institutional trust quietly bleeding out until a shock exposes how hollow the structure had become. Ghazali would not have been surprised by either example. He'd argue he already gave you the mechanism 8 centuries earlier. So what do we actually do with this today, watching all of this from 2026 in a world of algorithmic markets, global supply chains, and instant digital currency transfers he could never have imagined? I'd argue the most useful thing isn't nostalgia for medieval wisdom. It's recognizing that his core test still works as a diagnostic tool, even on systems that would look like science fiction to him. When you look at any financial innovation, a new derivative, a new crypto token, a new lending product, ask Ghazali's question instead of the usual one. Not, is this legal? Not even, is this profitable? Ask, does this create real value? Or does it just move value from someone less informed to someone more informed? That question would have flagged predatory subprime lending practices years before 2008 without needing a single regulatory filing. It would flag currency debasement through unchecked monetary expansion without needing a PhD in macroeconomics. It would flag speculative bubbles the moment price becomes disconnected from anything the asset actually produces. None of this requires believing in anything supernatural. It requires taking seriously an idea modern economics sometimes forgets. Markets are made of people, and people respond to incentives, trust, and fear in patterns that are remarkably stable across 1,000 years of radically different technology. Ghazali's real contribution wasn't a set of specific policies. Half of his 11th century context doesn't even map onto our world directly. His contribution was a method, a way of asking whether an economic system rewards contribution or rewards extraction, and understanding that the answer to that question eventually determines whether a civilization stays wealthy or slowly hollows itself out from the inside. That's not medieval religious moralizing. That's a functioning model of systemic risk, built centuries before anyone had the vocabulary of systemic risk at all. And maybe that's the real lesson buried underneath 800 years of history. The tools of finance change constantly, but the questions worth asking about it barely change at all. If this reframes something you thought you already understood, that's the whole point. Subscribe for more of these deep dives into the ideas history left behind.